Hello everyone, I'm Shekhar from Momentum Lab. Welcome to the weekly review. This is day 69 of my momentum investment journey, building it in public. And in this weekly review, I'll talk about three things. One, how is the market performing? Second, how are the stocks that I own shaping up? And thirdly, how is my portfolio doing? Now, before I begin, let me also tell you guys that I'm not a SEBI registered advisor. Whatever I'm presenting is purely for education and knowledge sharing purpose. So let's look at the markets. I take into consideration the five markets by the market cap wise alongside with gold. Gold is a contra indicator. It just helps us in understanding whether the equities are doing well or not. So if you look at the equities, the best index is Nifty Mid Cap 150 because of three reasons. It is making consistently higher high and higher low market structure except for the election crash. I'm going to talk about election week separately. Second reason is it is in a proper order of the closing being above the 21 EMA, being above the 50 EMA, and 50 EMA is above 100 EMA, 100 EMA is above 200 EMA. The third reason is it is at the all-time highs, almost near the all-time highs. So these are the three reasons I've given the mid-cap index as the first rank, and this tells that the stocks within the mid-cap index are performing really well compared to the other uh, stocks. The second rank I've given to Nifty Junior and Nifty. Nifty, in fact, has pulled up from a couple of weeks earlier. Nifty was somewhere at third, fourth, or fifth position. Now it is come to second position. But the reason because I gave it is that it is at all-time highs, close to all-time highs. It has been in the sideways trend for last 3 months. Now it has given upside trend decisively and moving upwards. You can also see the volumes. The volumes are above average when the reversal has happened. Nifty Junior, it's consistently performing and it is also in an upwardly trend of higher high and higher low structure. The recent closing is not as close to its previous high, but not it should not matter that much, hardly a few points here and there. So overall, these three indices are really good. In fact, small cap and micro cap 50 are also decent enough, but not compared to the mid cap and Nifty 50 because they are not in a higher high and higher low structure. They're still having a horizontal resistance. So if the horizontal resistance is broken out, then we can term them to be eligible for a higher high and higher low structure. And the stocks within the micro cap and small cap also will start to move. So small cap is also same, just like micro cap, having a horizontal resistance. Now let's zoom in for the last 1 week only and see if there is any change in market structure or not. I'll take Nifty 50 as the index and see how it has performed during the election week. So the election week on Monday started with a good note. There was a gap up because the exit polls predicted a sweep for BJP and India government. And on Tuesday, when the actual results were announced, the results were not in favor of BJP plus India government. BJP or India, they just scraped through the majority mark. And hence, as a result of it, there was a sell-off from its all-time highs. It went all the way till its 200-day EMA in one single trading day session, and it fell by almost 8.5%. So that was a very volatile day, and most of the stocks corrected. You could see the breadth on that day. You can see the breadth by the 4% advance or decline uh, uh, indicator. So what this indicator tells is, let's say if a stock has made a 4% advance on any trading day, then we count it as one, let's say. And if any stock has made 4% decline, okay, then on any trading day, then we count it as, let's say, -1. Now what we do is for all the 750 stocks in Nifty 50, we count how many plus ones are there or how many stocks have made a move more than 4% or above. Similarly, we calculate how many stocks have made a move of -4% and below. So if the number is negative, the net number is negative, it means that there are more stocks which have made 4% or more decline. If the number is positive, it means that there are more number of stocks that have made 4% or above up move. So on the election results day, you can see that 70%, yeah, 70% of the Nifty 750 stocks have corrected by -4% or more. So that is a widespread sell-off that has happened on the election day. And the next immediate day, we again could see that there's a bounce on 35% of the stocks have made a move of 4% and above. And that continued for the rest of the week also. You could see that there's a healthy green line for Wednesday, Thursday, and Friday. So indicating an uptrend. So the breadth had deteriorated suddenly if it deteriorates suddenly, you can term it as like a jerk or a crash, and then it immediately recovered the next three following trading day sessions. So and hence the last 1 week was volatile. But if you zoom out and see in a larger picture, the big wick is visible, but it looks everything is in uptrend. Nothing is in uh, going down, or there's no sideways. It shows that it is an uptrend when we zoom out. But when we zoom in and see the day specific, yes, it looks like a big flash crash that has happened on Tuesday, and now it has resumed. So you could see one more difference, that Nifty 50, when it fell on the election day, it touched almost the 200 EMA, whereas the other indices like Nifty Mid Cap 150 or the Nifty Junior, they didn't even cross below the 100 EMA, indicating the strength of this index. And it also indicates the strength of the stocks inside this index, because the index is made just of these stocks, right? So that's another indication, like where to find your trades or where to invest in this trend. So on an overall, I see that the market structure hasn't changed in the last 1 week. There was an aberration, but again, the trend has resumed. So let's also look at the Nifty 200 index, because my focus is always on this index. This is the index that I invest, as in the my universe of all the stocks that I select come from this index. So I'm more worried or more focused on this Nifty 200 index. Now, Nifty 200 index has been going through a channel since last 6 months. Now, this channel is intact. You could see that there is a breakout from this channel on the exit polls day, and this is a false breakout. Quickly, there was a correction, and on the results announcement day, there was a false breakdown, and again there was an up move or a resumption of the trend, and the Nifty 200 again is back in the channel, now at the highs. Now it needs to be seen whether it can break this or not. If this is not broken, again this will act as a good resistance, so we can again expect some kind of correction to happen. Now let me show you the stocks in my portfolio and how they have performed. So in this week, I exited 4 stocks. The 4 stocks are BDL, BEL, BHEL, and HAL. So all the PSU stocks. So let's see the reason for exiting. The reason for exiting in between the rebalance is in only one condition. That is, if a stock falls by 20% from its 52-week high. So that has happened in the case of BDL. So from its 52-week high, it fell by 20%, and hence I had to exit this stock. So when I say fell by 20%, right, I take into consideration the closing price. So at the end of the day, if the closing price of any stock is lesser than its 20% from its 52-week high, then I exit. If you take, let's say, the case of CG Power, you notice that the stock also has corrected by more than 20%. In fact, it has corrected by 20. Yeah, same. It has also corrected by 21%. But I did not exit the stock because I did not get the exit signal. Reason being, the exit will happen only on the basis of closing price. The stock CG Power did correct by 20%, but again within that same day, the closing happened much above or much above the low levels of that day. It started at this level and it fell by only 10.72% on closing basis, indicating that there is strong buying power or buying pressure, and hence the buyers are not letting the stock fall by 20%. They're ready to lap it up. So these indicate that the stocks are good, having good strength. So that is the reason for exiting BDL. Same is the case with BEL. BEL also had a 20% fall from its 52-week high on the closing basis. Now let's look at BHEL also. BHEL had a very big fall. In fact, it had a fall of 30% from its 52-week high. But if we take in terms of closing basis, it is at 23.37%, and we had to exit this stock. Now let's take the case of HAL. HAL also fell by 28% within 2 or 3 trading sessions, but not on closing basis. On closing basis, it is somewhere around 20.51%. So I had to exit these stocks. The reason I exit a stock if it falls by 20% is that any stock to make an uptrend, it definitely needs to consolidate. But if we give it more room as in if we give more than 20%, let's say 25% or 30%, then the chances are that we might get stuck in that stock for a longer period of time. Or in the worst case, if it is not consolidating and if it is starting to fall off, then we might give up the most of the gains that we have secured. So to ensure that trade-off between giving some chance for the stock to recoup and cutting the losses, I chose this hard stop at 20%. You can choose whatever number that you feel like is comfortable for you. So right now I'm left with 11 stocks. Let's see each of these charts one by one. So I like a couple of charts among these 11 stocks that I have right now. The reason being, if after any crash, if the stock quickly resumes and reclaims all-time highs again, it means it is having a very good strength. So I'll show a couple of examples. Prestige. Even after the crash, it could reclaim its all-time highs. Now take the case of ABB. ABB had a crash, but it could not reclaim its all-time highs. Same is the case with Siemens, CG Power, RVNL. Indigo is trying to reclaim its all-time highs. Dixon, if you see again, it has reclaimed its all-time highs very quickly in just 3 trading sessions. Indus Tower, not all, yeah, almost close, but not that close to its all-time highs. It is around 5-6% from its all-time high. So that's one way to identify which stocks are having strength and which ones are not. Adani Power has still long way to reclaim its strength. Let's see Vedanta Limited. Vedanta Limited is around 8.5% from its all-time high. It also corrected a very sharply, like 27% from its all-time highs to the recent crash lows, but it quickly bounced back. So if you see, there are 3 ways you could categorize the stocks which have corrected and again reclaimed their all-time highs. These are the category 1, high strength stocks. Then the second category where they have corrected, but they have quickly bounced back. They've bounced back, but not at the levels of all-time highs. These are category 2. And then there are category 3. Category 3 are the stocks which have corrected and are languishing there. So ideally, I want to cut off the category 3 stocks and keep only category 1 and category 2 stocks. So again, when the next rebalance comes on 15th of June, I will be picking up 4 new stocks. And I'm keen to see whether there is, if there is any sector rotation or not, because I see that all of my PSC stocks have made an exit, right? So I'm curious to see if what sector will be coming up next in terms of strength, or again whether the PSCs make a comeback or not. So to do or check that sectoral rotation, if that is happening or not, there are some couple of free tools available. The important tool that I like is RRG graph. RRG is nothing but relative rotation graph. I'll explain it in detail later. So what RRG does is it helps you identify if there's any sectoral rotation or not. So first, let me give you a brief example of what RRG graph is and how is it plotted, and then I'll talk about sectoral rotation. How do you plot it? So you see this index, so this grid, 4 by 4, 2 by 2 grid, having 4 quadrants. Now on the x-axis, you see a relative strength ratio. Relative strength is nothing but when you divide any index or a stock by a benchmark. That benchmark could be, for example, a 50, Nifty 50 here. And when you divide that, you get what you call a metric as relative strength. Now that relative strength is a static number for that period of time. If that relative strength number, is it increasing or decreasing day by day? If it is increasing, then we say that the relative strength is gaining momentum. Now that relative strength gaining momentum, we use the y-axis for that metric. So if a stock is having good relative strength, then it will fall on the right or above 100 figure in these 2 quadrants. If the relative strength is increasing or improving day on day, then it will fall on the top right corner of this quadrant. It is called as leading sector or leading stock. Now, ideally, we want to invest in stocks which are in leading because they have a very good relative strength vis-a-vis the benchmark and they're continuing to outperform the benchmark. The stocks which we don't want to own are the lagging stocks. These are the stocks which are not doing well with respect to benchmark and in fact are deteriorating or worsening with respect to benchmark day on day. What we call them as lagging stocks. And then there are other 2 quadrants, improving or weakening. Improving is basically the stocks which earlier had poor relative strength, but now they're improving their relative strength. meaning their relative strength ka momentum is improving, and hence these stocks or the stocks which are falling in this quadrant are the stocks which are to be focused next, because they could be potential winners. And the weakening stocks are the opposite of improving stocks. These are the stocks which had a very good past, which had a very good relative strength at some point of time, but now are worsening day on day, meaning their momentum is now falling. So they are like fallen stars. Their glory is good, their past is good, but now they are not doing that good. So they are weakening. Ideally, you want to cut out these stocks. So if you imbibe these traits or these features into your trading style or into your algorithm, automatically you will be following the momentum principle of buying the strength and selling the weakness. Now let's see if my stocks that I sold, where are they falling? In which quadrant? The stocks that I sold are BDL, BEL, BHEL, and HL. Now, all of these are uh, CNX PSC index. They fall under CNX PSC index, nothing but Nifty PSC, Public Sector and Undertaking Enterprise Index. So I'm using a tool called Strike. Strike, this tool provides you an RRG chart free of cost. I'm not sure how long they'll make this free, but you could use till it is free. Now, in this, when you come to this chart, you could see that there are 4 colors indicating each color for each quadrant. Now, I'm interested in my. So you can select Nifty PSC as an index. Nifty PSC is the index that contains my stocks. Let's see what are the constituents of Nifty PX of Nifty PSC. So let's open this and see. Bharat Electronics, BHEL, HAL, all the PSU stocks are there in this and cover most of my stocks that I exited Nifty PSC. So let's take a look at Nifty PSC and see how it is performing. As you can see, it was leading a couple of days back. Now it is weakening. It doesn't mean that if an index is moving from one quadrant to another quadrant, it doesn't mean that it will stay in this quadrant forever. It can again come back. So what it just tells us is that there has been a change in sector rotation in the last 1 week. Now it needs to be seen that whether the sector rotation is permanent, as in we see that new set of stocks emerge from now on, or do we see that the same old stocks again come back, make a comeback and start to outperform. So we are not in a hurry to quickly pick the stocks. We have a 14-day window to do a rebalance. So in the next rebalance, which anyhow will come in the next week, we'll see whether the same set of stocks are coming up again, or are there new set or new crop of stocks that have come up. So this way, I'll be able to see and pick the stocks in strength, and also eliminate the stocks which are not in strength. So this is this RRG graph is a very helpful way to visualize the index and also the individual stocks and see. I'll also show you how to see, for example, an individual stock and see how is it moving. You can type by the, for example, let me click on add and let me search for a stock called BDL. Select stock, done. Now this BDL, I'll only select the BDL. So if you see BDL, it has been leading and now it has started to come to the weakening quadrant. Again, when it comes back, it gains momentum. Anyhow, it will show again in our momentum ranking screener. If it again comes up in the top 15, we'll pick up. No problem, because we've already done that earlier also when ABB went away from our momentum ranking and again it came up. So that's how you can use the RRG chart. Let's now look at the portfolio. So in my portfolio, I'd like to show you one important mistake and learning that I had in the last week. So anyhow, the typical metrics you could gauge by looking at this dashboard, which I share in my YouTube link description. So the important metric that you need to focus is the NAV. So if you see my NAV, which is in blue color, for the last 1 month, it was comfortably above the Nifty 200 index, which is in the red color, by 6% basis point, 6% point, which is very healthy. So if let's say the index was at 104 levels, my portfolio was at around 110, 111 levels. Now, in the last week, it has completely evaporated. The difference between my NAV versus the Nifty 200 NAV. Now my NAV is lagging the Nifty 200 index by 2 percentage points, or alpha is at minus 2.09. The Nifty 200 index is at 105.6, whereas my portfolio NAV is at 103.5. Now, the key reason that I understood why this happened is because if you remember last week, I was showing you guys that my portfolio heat, which was at that point of time somewhere in the levels of 250 and 270%, which is way above the worst case loss. The worst case was in somewhere sub 1 lakh range, and the profit I was sitting in the range of 4 lakhs, so 3.5 to 4 lakh. So what does it mean? It means that I am now exposed to less risk. If I'm exposed to less risk, then there's an option for me to take on more risk. I can take on more risk through two ways. Let me explain you with this graph. Now let's assume that this is my portfolio equity curve. And for a moment, let's assume that I've invested at a level of 100, this green line. I've invested at this level. And I consciously took a decision that if the portfolio falls by 10%, I'll exit. So for a moment, assume that the level 90 of this index is my stop loss. And this stop loss of 10% is not a static line, meaning this 90 will not be here. I mean, I'll not exit always at 90. This is a trailing stop loss. If my equity curve moves upwards, then I'll also move my stop loss upwards. For example, if my equity curve is at 110, then I'll move this stop loss to, let's say, 100. When it moves to 100, it means it is equivalent to the buy price. And hence, I'm break even. There is no risk that I'm taking. And if, for example, if this NAV goes even further up, for example, let's say it goes to a level of 120, obviously I'll improve or increase the stop loss also to 110 level. Now I'm sitting at a profit of 10 rupees any which ways. Even if the stock market corrects or if the portfolio crashes, I know that I'm going to exit at 110. So for me, this is a sure shot amount that I'm going to get. Now, in this case, this is what has happened last week. I was sitting somewhere in this kind of a scenario where I was very close or above the buy price on most of my stocks. And hence, there was considerable room for me to take more exposure risk. As I mentioned, there are two ways to take more risk. One, you could reduce the stop loss further. For example, if this is the stop loss, let's say 10%, if I was holding, I could reduce the stop loss and bring it down to 20%. Meaning I'm giving more room for my portfolio to fluctuate, thereby ride a larger trend. If I'm keeping the stop loss too tight, then some of the whipsaws can throw me out. Now, if I want to stay for a longer period, I should have that risk appetite to bear a larger drawdowns. Now, you can bear larger drawdowns only if you have the capacity to take them. The capacity to take them is possible when you have some profit or at least your break even. So that's what you could do. You could reduce your exit criteria. Let's say if my exit criteria for a stock exit was 20%, right? If I bring it down to 25% or 30%, I could still take on more risk and continue with the same set of stocks. Or the other way is you don't take or you don't reduce the stop loss. You let the stop loss be as is, the whatever number or percentage difference, but you top up more so that you bring up the average buy price to these levels. So you could take on more risk by two things. One, either increase the threshold for stop loss, or top up or buy more so that your average buy price increases and your threshold for stop loss remains the same. I chose the second way, which is to top up. So that's the reason you see in this chart. Let me quickly draw a chart which shows the amounts that I topped up on a daily basis. On the x-axis is the invested amount, on the y-axis is the date. So I invested gradually 8 lakhs for the first 1 month. So my target was to get up to 24 lakhs and stay invested for that levels. Now, once I had 24 lakhs and I saw that the portfolio improving, I got sufficient room to take more risk. Now, to take more risk, as I mentioned, instead of lowering the stop loss levels from 20 to 25 or 25 to 30, I topped up. You could see this bump, right? I topped up. Unfortunately, this topping up happened just on the day of exit polls. And right after I topped up, the market crashed, bringing down the entire gain. So, since I had sufficient buffer, I still ended up having minimal uh, profits because I was already sitting at 11% gains, right? So the crash, you can see the crash. So even after at 11.5% profits, after the crash, I fell to a level of 97.35, meaning I lost somewhere around 12 to 13% on the results day. Again, it could recoup over the next set of days. And by the end of the week, I was at 103.5, right? I'm at 103.5. So that's the scenario. For a moment, let's assume that had I not topped up, instead of that, let's assume if I had increased my stop loss levels for the stocks by 5 percentage point, that is from 20% to 25%. In that case, what would have happened is I would have not exited most of my stocks because you see, let's take the case of BDL. BDL, as I was showing, right, it fell by 21%. So if my new stop loss was at 25%, I would have not sold this stock. Same case with BEL, HAL, BHEL, and HL. You can check that because these stocks have not corrected by more than 25%. They've just corrected by 20%. But still, that's okay because they're all part of the game. You position sizing is also not. You learn through the mistakes that you do. So the main thing that I've learned here is to actually avoid topping up during non-volatile weeks. So that is one of the important learning that I had, that watch out for major events and do not do something fancy just before the major events, because I was just following my set of rules. June 3rd happened to be a rebalance day. I went ahead and did my rebalance without thinking about the market and all. I think that's a major learning that I had. Let's see if there are more learnings that I discover in future. I'll be sharing with them. Now, if you see the exit for a moment, the last four stocks, no, BEL, BHEL, HL, and PDL. Now I had to exit HL and BDL at some good profit because even though they credited by 20%, still I was able to sell BDL at 23% profit and HL at 11% profit. BEL and BHL I had to sell at minus 19% and minus 10% respectively. BEL at minus 19% because I purchased it on 3rd March and sold it on 4th March in just in one day. So that's the reason I had to sell it off at minus 20%, the max level. Whereas BHL I had some buffer, minus 10%. So net by selling all these four stocks, I did end up making some money, but not much. The important point I was mentioning, right? So had I not topped up, but instead lowered the stop loss, then what would have happened is I would not have sold BDL, I would not have sold HL, I would not have sold BHL, I would not have sold BEL. All these four would not have been here, and they would have been here. My unrealized profit would have been higher, and my NAV would have been even higher than the portfolio or than the index NAV. So that is the major learning. See you next week, guys. Thank you. Bye.